Welcome back all to Tech Tune-Up. I'm your host, Paul Meeks, brought to you by my friends behind me, the investment bank at which I work, Freedom Capital Markets, and always my buddies at Benzinga. I have not seen you for 2 weeks, so we have lots to talk about. I think it's going to be a power-packed show. Hopefully some great investment ideas shared, both long and short. So let's get right after it. So first of all, we can't go another week without bludgeoning of news from OpenAI. Since we were last together, OpenAI had their Dev Day, their big event for software developers. And what I see happening here with OpenAI is in the AI era, they want to be what Apple was to the mobile era when they initiated the cell phones, the iPhone in 2007. They became, some people on the street like to call it a walled garden. Others called it the ecosystem, but actually it did very, very well for shareholders. So OpenAI wants to do the same thing, essentially vertically integrate every aspect of AI with a ton of deals with marquee tech partners. Some are also lending them money in exchange for OpenAI to buy their chips, which is a bit controversial, but that is what it's all about. And one of the things that they did or shared at their Dev Day was consumer-facing products that will take Apple head on. So we'll see what happens. That's what they're trying to do. If they're successful, you know how well Apple did for shareholders, at least over the last several decades. So next, we're now up to $1 trillion in AI investments that they have promised with all these different partners. However, the company this year will only do $13 billion in revenue. And in their last private valuation, which was $500 billion, OpenAI, not even a publicly traded company yet, has commitments to spend up to $1 trillion over the next several years, and the company's being valued at a whopping 39 times sales. Not 39 times earnings, 39 times sales, even as a privately held firm. So there is some pressure there that at some point you have to monetize all this spending, and that is if and when the AI infrastructure bubble pops. We will see. When the internet bubble inflated in the late 90s and popped in the early 2000s, at that time, for Merrill Lynch, I managed the largest tech mutual fund on the planet Earth. And so hopefully I have an insider's perspective of what can go right and what can go wrong. So make sure that you tune right here every week on Tech Tune-Up. I do think that they have announced some interesting partnerships that maybe are not so obvious because they're not just tech chum relationships. OpenAI has announced a deal with Walmart. I think that'll be quite interesting. You know, Walmart is, after the federal government, America's largest employer. And so, yes, if this is taken on, if it can prove to be monetized at Walmart, a very good, a very powerful use case for OpenAI. So we saw that they have now a custom GPU partnership with Broadcom. They also have signed a deal with ARM for CPUs. And of course, we announced before, and you've been reading it in the media, the big $300 billion booked relationship with Oracle for Oracle Cloud Services. So we'll see how this goes, but man, $1 trillion to be spent in the next 5 years, unprecedented, even in the crazy world of tech. Now, as I told you, some of these deals are interesting because Nvidia and AMD, the two major GPU companies, are taking equity stakes in OpenAI in exchange for data networking and GPU sales. Some folks call that a circular relationship. We saw some of those end very badly and helped the internet bubble pop in the early 2000s. So let's stay attuned for these red flags. Since we were last together, ASM Lithography, the Dutch semiconductor capital equipment, surprised to the upside. And the stock got at least a bit of a lift because the CEO said that in 2026, total revenues for the firm will be higher than 2025. When they announced the June 25 quarter, their guidance at that time for 2026 was a down year in revenues. So things are going a bit better for them. But if you peel back the onion, the guidance is still for a huge decrease in sales to China. And you won't see that shift to the good until we have a resolution of the trade deal between the US and the Chinese. Oracle got a little bit of heat. Now, since we last got together, Oracle had a quarterly report. Then it hosted a day for Wall Street analysts. I attended. And then the stock got hammered despite the fact that at their analyst day, they drastically took up for revenue and earnings their long-term targets. But here's the rub. There's a periodical called The Information that published a report based on insider sources, but not documented, at least in the article, that Oracle is only earning a 14% gross margin on its early deployments of Nvidia chips. That would be a downer because Oracle, as a software company, generates typically a gross margin that could be 70, 80, even 90% in some product lines. And after all this spending, if the gross margin actually stays at only 14%, that is bad profitability. So to support them, you could say that in the early stages of a ramp, a lower gross margin is expected. But we'll have to see where that gross margin goes over time, because this might be careful what you ask for. You spend all this money, and if it happens to have shitty profitability and shitty cash flow generation, bad thing. And so that's why, despite all of these wonderful press announcements, particularly after Oracle's Analyst Day, the stock has actually come back, and it's come back a lot. It's probably just a hold for me right here. CAIA, which is Elon Musk's company, has done another round of private financing, and that's not particularly interesting. The interesting thing is that Nvidia was big in the private financing round. Nvidia is just trying to sprinkle the infield and make sure they're with all the players. It's almost like operating as a venture capital fund. You invest in 10 companies, a bunch will be zeros, hopefully a couple tread water, and then you have a couple home runs. Nvidia is acting just like a venture capitalist. Next, Netflix is reporting tonight. I don't really have a call on the quarter. The stock has been range bound for months at a low of 1,150 a share to a high of 1,250. The stock is probably not worth buying until it breaks out of that resistance at 1,250 on significant trade volume. Will we get news today that allows that stock to do the very thing that I'm asking for at 9:30 Eastern when the New York Stock Exchange opens tomorrow? I don't know. One of the things I think is interesting is Warner Brothers Discovery is in play. They even announced it today. They're officially in play. And I'm hoping, as I've said before on this show, that Netflix is not stupid enough to buy that bag of shit. Let Paramount or whoever buy Warner Brothers Discovery. It would just be massively dilutive to Netflix business, in my view. And they have such a lead in content generation for video streaming. They don't need that content. So we'll see. I'll be on that quarterly conference call tonight, and I'll be reporting back to you next time. So you know that we're very keen here on AppLovin. Now, I hope you sold AppLovin at 650, where I told you to sell it, because since then it's gone to 750, but then it is reversed and now it's way down. So you may recall that short sellers went after this company in February to March of this year with lots of accusations. But the new bad news is we know that the SEC has been investigating since then, but they haven't come up with anything or they haven't announced anything. Not to say it won't happen, but I'll talk about that in a second. But the most recent catalyst came yesterday, where the New York Post took all of those short sellers' accusations and spread them to the masses when they published their paper yesterday. And so now everybody knows. So I will tell you, it's not new news, but it is new news to the masses. And that's going to put pressure on AppLovin until the SEC says yay or nay and what the punishment will be. I think what happens in the end, because most SEC investigations, which are not criminal investigations, end with a fine, and sometimes they can be whopping fines, but AppLovin could easily pay a fine. The question is, if they're proven guilty, if they pay the fine, no big deal. The big deal is, do they have to tweak their business? I think what happens in the end, they will have to tweak their business in a way that actually will not be material to the overall story. And they'll pay this fine and they'll get that past them. And then I think, unless AppLovin's business model is permanently impaired, and I don't think it'll be, this could be a nice opportunity. So right now, if you missed your 650 sell limit, I would just hold it and wait for more news. The company announces their quarterly results, I believe, on November 5th, where they'll probably address this issue, unless their lawyers say they can't talk about it on their quarterly webinar. But right now, frankly, you guys, it's too late to sell AppLovin. It's less than my sell target. And also probably with this swirling over our heads, this controversy, this regulatory stuff, can't buy it either. If you own it, do just like I'm doing it. I'm just holding it. So the other stock that's always on Meeks' front of mind is CoreWeave. CoreWeave has also taken a bit of a shitter in the last couple of sessions. The big driver here is, back in July, CoreWeave announced that it was acquiring Core Scientific for, I believe it was a stock-for-stock deal of $9 billion. At the time, people thought, that is dumb. Why are you paying so much money for this bag of shit? It's essentially because CoreWeave needed their power to build more data centers. So there's been a lot of pushback since then by Core Scientific's shareholders who say that they're not being paid enough for their property. I actually think, because on October 30th is the shareholders' vote date, I actually think that this deal probably doesn't happen now. And in one sense, it's bad for CoreWeave because they don't get their power. But on the other sense, I think they were spending way too much. And if they step away and not raise the target, I think that they're showing some financial discipline, which I think was and is necessary at this company. Now, remember, my sell limit here was 150. Since the last I spoke, we got to that 150 handle just momentarily. Now we're backed off. So I'm giving you the same guidance for CoreWeave as AppLovin. Too late to sell. Unless it gets back to 150, then please do, or at least sell a piece of it. Too controversial to buy until they announce their own earnings. And I don't think that they've come out and told us specifically when they're going to drop their earnings, but I'm guesstimating, just guesstimating, it's going to be around November 13. I think Alphabet is interesting, and the stock's getting whacked today. It might give a nice buying opportunity. Waymo, their autonomous vehicle venture, has announced they're now going to start testing vehicles in Europe. And that is way before Tesla has been given the same opportunity. So I think this is a pretty big deal. And you've heard me say it here first. A lot of people just assume, particularly with Elon Musk's aura, that when it comes to autonomous vehicles, that Tesla's going to dominate. I don't think so. They will be a player for sure. They will be a major player. but they're going against Alphabet and Amazon. Who's to say that those guys won't be number one and number two? So anyway, don't believe Elon Musk's bullshit. So Tesla, no surprise, is going to announce their quarter. Now, they give us a monthly sales report, so it's not usually much of a surprise. But I will tell you, I expect when they report their quarter that they're going to give a really bad outlook for 26 for their electric vehicles. And so what Musk will do is to play 3-card Monte with you. And while you're looking at the EV business, he's going to direct you to autonomous driving and robots, because the EV business is in some serious peril and it'll really come home to roost in 26. So he'll say, EV sucks. Don't look at EVs. Nobody cares. Look at our robots and particularly our autonomous vehicle fleet. So we'll see. EVs will suck in 26. It'll be probably worse than anybody expected. But they have a lot of heat on them to deliver finally, after all these years, the dream of autonomous driving, or else that stock, I think, could get absolutely hammered on the downside. So let's take a look, as we always do, at some of my picks. I should, because I truncated that bit a little bit, I should hit on Dell, which I'll talk a little bit more here. Probably my favorite growth at a reasonable price, or GARP tech name right now. They had their analyst day as well, and they gave guidance, which I actually believe is legit, unlike Oracle's guidance, for their revenue and earnings growth rate to double from previous estimates. And Dell is only trading at about 14 times earnings, even after it had a little pop after its quarterly announcement and analyst day. And the S&P 500 is growing at, or is valued at, over 20 times earnings. So I think Dell is one of the few names you can still pick up in the tech sector with some valuation support. And then also you saw there on the previous graphic, Taiwan Semi, Nvidia, mighty Nvidia does not exist without Taiwan Semi. And Taiwan Semi, one of my favorite picks for years, had a great quarter, great guide for next quarter, great guide probably for next year once we get into the December, January timeframe. You got to own that one, even with the geopolitical risk that China will decide to take Taiwan at some point. So let's get to some of the tech picks. You know, I'm really going to only highlight the ones in which we've had some movement, right? Some change of opinion. When I take a look at these, I've mentioned most of them. I'm going into earnings season, which makes me a little bit hesitant to push anything too hard, because quarterly earnings reports can always be disastrous. Sometimes the company not only beats Wall Street's estimates for the quarter for revenue and earnings per share, they also beat with their guidance for the next quarter for the same two metrics, yet the stock goes down the next day because somebody was disappointed with something that they said during the hour-long quarterly webinar. So unless you have a real solid lead on the fundamentals, almost if you have to know insider information, which of course we don't do that because that sends us to the big house, I really don't like to buy ahead of quarterly reports. Too much information is coming, and it's always worth waiting for it. So I'm taking a look at a couple of stocks in which I've had a change of heart. One of them is Uber. Last time we got together, I was a buyer of Uber. I had it marked green. I still like it long term, but we've seen a technical breakdown. So I have moved to the side on Uber, just not buying it fresh, just still holding it. Another stock that I had on my buy list that I'm downgrading to the bullpen is Nebius, ticker NBIS. This is a Dutch CoreWeave lookalike. Same thing has gone down, a technical breakdown, probably also down in sympathy with all this rotten news, or potentially rotten news, from CoreWeave, because people think they're a 1-2 punch. But anyway, let's stay aside on Nebius until they announce their own quarter in a couple of weeks. I would say the other stock that I think is quite interesting and maybe a buy today, in addition to my friends at Dell, which I just explained, is Constellation Energy. Quite often when I do this show and we get to the Q&A, somebody's asking me for a energy pick. And in the past, I've come up with GE Verona, GEV. That's been a good one. But I would tell you, take a look at the article that was published in Barron's this past weekend on CEG. I think CEG, particularly since it's come back to its 200-day moving average, which is about 365 a share. And then I even looked today before I got on this telecast, it was trading down to 359. So CEG, with its nuclear fleet, with its deal to buy Calpine and bring on nat gas energy capacity, will be a very good player and a necessary player in the continued build out of AI data centers. And the stock has come back, so it could be timely. What I'd probably do is, I like Dell, I like CEG. CEG, because it's technically breaking down, I think you should, if you go for it at all, just buy a small starter position. But I think it's cool to do that right here, right now. Let's get to some of my tech trends before we wind up. No doubt, at least in my opinion, the Fed will lower its benchmark interest rate at the end of this month by 25 basis points, and then do it again in December for the final meeting of 2025. Even though inflation is still a little bit sticky high, labor market has deteriorated in this country modestly. And so I think this is a done deal. It does set us up a little bit nicely for valuation for tech and other aggressive growth stocks, which crave lower and falling interest rates. So one of the things I've noticed, and it's starting to worry me, because remember, I was one of the big fish during the internet bubble as it inflated and then popped, is you're getting some very wild AI spending forecasts out of all of the major Wall Street investment banks. It's $1 trillion, it's going to be $2 trillion, it's going to be $3 trillion. I don't know, but the discussion of all these trillions has got me a little bit worried. So anyway, take these crazy, very aggressive forecasts and maybe dial them back a bit. Maybe not a bit, dial them back a lot. I still am big on the AI infrastructure trade. I think it continues for a few more years, not because I believe in those big of spending numbers, but I believe the people or the companies that are spending are the majors, and the majors have the deep pockets to do so. So that's really my biggest reason. But one thing that I should mention, which does blow me away, and this is not a prediction, it is a fact. But consider this, even if you're not a tech investor. Right now, 40% of the growth in our economy, gross domestic product, is coming from AI spending. 40% of our economy. And about 80% year to date of the move in stocks, take an index like the S&P 500, is coming from the same old AI infrastructure building plays, mostly semiconductor companies and some software companies. So that type of concentration to drive not only the bulk of the stock market's gain, but even 40% of the giant, which is the US economy. Wow, we didn't even have that kind of driver or concentration during the internet bubble. Another trend that I'm watching is this trend I've mentioned before in the prediction markets, which is a fancy way of saying how people can gamble on NFL football without going through the regulators. But this market has become a pitched battle between Kalshi and Polymarket and all of the partners that are lining up with those two companies. So the prediction market could be a very big market indeed. It could be the way that you invest abroad. could be your opportunity to get into crypto. So watch for these prediction markets. And as of a couple weeks ago, nobody had heard of Kalshi or Polymarket, and you will hear some more. I got my ears up for them. Government shutdown continues. As I told you before, this is bad for business, because if I'm a CEO or CFO, I am going to hold back on aggressive spending, except for AI, which nobody seems to give a shit about any kind of obstacle, because I just don't have confidence to do it in this morass. And it's not a Republican problem or a Democratic problem. It's a both problem. So hopefully we get through this, because you don't think it's directly impacting tech stocks? Oh, sure it is. And also the other one that's even bigger is if and when we come to a trade and tariff deal with the Chinese. Huge impact, huge impact. One of my favorite stocks is Alibaba, and I would buy that one right here, right now, because they're doing a lot of very interesting things, taking advantage of the AI boom. And they're even going to announce a chatbot, I think, soon to go after ByteDance. ByteDance is the big Chinese company that owns TikTok. But when we have a deal between the Chinese and the US, and I still think it's going to happen at some point, don't know when, Alibaba should get an extra boost. So put Alibaba on that buy list too. And the last thing I wanted to say here is I got a really nice debrief. And I'm going to call him Dean from New Orleans, because I don't want to out him on YouTube. But he is a follower of this program. He went to Quantum Beach, which was the quantum computing conference that I was planning to go. Then I got dragged away by my investment bank, so I couldn't attend a couple weeks ago. Anyway, he went. He gave me some great intel. He's become a good source for me. We're buddies now, and all this came through Dean from New Orleans watching me on Tech Trends. So with that, if you have any questions, let's get after them. What do you think about UMAC? This comes a question from Andre L. Don't know enough about it. Sorry, man. But I'm putting it on my list to address it next week, or during the next week to talk to you about it next Tuesday. All right, guys. I will tell you something that's funny about that is during the internet bubble, I was a weekly guest on something called CNN FN. So CNN had a financial news network back then, right? Everybody was talking tech. They would have me on the show, and it was a show kind of like Kramer does in the evenings on CNBC, where people would call in and say, just like we do here, what about this stock? What about that stock? And you look really smart on those shows. You want to know why? And Kramer too, is because the producer will, in your earpiece during the commercial break, say, okay, we got 5 people on the line. These are the 5 stocks they want to talk about. And then you as the anchor or the commentator would say, don't know those 4. I know that one, so let's talk about that. So it looked like when the guy came back on live after the commercial break and asked the question, they said, geez, this guy always knows everything about every stock. Well, they were vetted during the commercial break. Obviously, we can't do that here. But anyway, I'm going to follow up on this stock. And you guys, I will see you next week, because between now and then, we got some really important tech companies announcing their earnings, and I will be on every one of those damn quarterly webinars. I'll see you next week.